Good afternoon. Okay. Good afternoon, everybody. Welcome to the June 2020 quarterly superannuation update. My name is Mailene Wheeler and I am the Associate Director in the Vincents Superannuation Advisory team. So let's just get our important message there with the disclaimer. And that's just my contact details if you have any questions in relation to SMSFs. All right, so let's look at our agenda for today. So what we'll be looking at are some of the upcoming dates, the key super-related tax lodgement and payment deadlines that will be coming up. We're going to discuss the super measures that will be in place from 1 July 2020. We're going to have a quick brief look at some of the ATO website and my.gov updates, as well as a brief touch again on what the MyGov app is. We're then going to touch base again on the Part A and Part B qualifications that are reported on SMSF annual returns. This is the second year that it's happening, so just a good reminder for everybody. We're going to look at the contribution caps that apply for the 2020 and the 2021 financial year, as well as going over the other contribution caps that apply for different superannuation related things and other thresholds to consider. Okay, so let's get started briefly with our upcoming superannuation lodgement dates. So the 28th of July, this is the date that your T-bar reports are due if you report quarterly, which is where you have less than $1 million member balance at 30 June. And it's also the due date for employers to have their superannuation guarantee payments for the June 2020 quarter paid to the relevant super funds. 25th of August is the date that if you have any activity statements that are quarterly, they're due then if they're being lodged through a registered tax agent or a registered BAS agent. 28th of October is the next due deadline for the September 2020 quarter super guarantee that employers need to pay. And then 2nd of November, if you've got an outstanding tax return for your super fund, your 2020 tax return is now due for lodgement on the 2nd of November. However, if you can get those outstanding lodgements done before then you will go back to your normal lodgement deadlines. Okay, so let's look at the super measures that are in place from 1 July 2020. So let's start off with some of the COVID temporary measure reliefs that have been done by the government for superannuation. So from 1 July 2020, super fund members can still access up to $10,000 from their superannuation accounts if they have been adversely affected by the economic conditions of COVID and meet the eligibility requirements. So under these temporary measures, you can access up to $10,000 of your superannuation savings. It's really important to note too that if you have a self-managed super fund, when you go through the process of applying for the relief, or for the release, if you haven't got your tax lodgements up to date, you're not going to be able to select your superannuation fund. So that's something to really be mindful of if you're in this situation and you'd like to apply for it. Now, applications must be made between 1 July 2020 and the 24th of September. They're only available to members who are in an accumulation phase, not in retirement phase. It's important to remember too that when you make the election, you only get to withdraw the money once. So you don't get to say, I'd like to take $10,000 out and do it in installments. It's one lump sum payment. So to be eligible for the COVID early release from super, you must be a citizen or a permanent resident of Australia and New Zealand, and you must satisfy one of the following circumstances. So you must be unemployed, or you're eligible to receive one of the following, which is the job seeker payment, youth allowance for job seekers, unless you're undertaking full-time study or a new apprentice, the parenting payment, which includes the single and partner payments, a special benefit, or the farm household allowance. Or you satisfy the condition of on or after 1 January 2020, you are either made redundant, your working hours were reduced by about 20% or more, including to zero, or you were a sole trader and your business was suspended or there was a reduction in turnover of 20% or more. Now, note, you do not need to keep any evidence or attach evidence to support your application, but it's really important that you keep records and documents to confirm your eligibility. The ATO has also advised that they will be looking into the circumstances where people are withdrawing the money and then within a very short time span recontributing that money back into their super funds to claim a tax deduction. So be mindful of these things. The intent of the COVID early release from super is to help people get through the COVID pandemic that we're facing. In addition to the COVID early release from super, the government did also announce temporary reduction to the minimum pension drawdowns for retirees to help them, because they're acknowledging that a lot of retirees have had their super fund balances impacted by some financial losses. So for the 2020 year, there was a 50% reduction in what people are allowed to draw down, and that's also applying to the 2021 year. Here's a table just showing for each of the age groups then a minimum percentage factor that they will need to withdraw. So this is based generally on their balance at 1 July 2020, whatever their super balance is that's in retirement phase. Normally, for example, if you're under 65, you'd have to take 4%. For the current year, it's only 2%. So it goes through there all of the rates for each age group. Okay, so another announcement that we've had, or another measure that applies from 1 July 2020, is that the super guarantee opt-out for high income earners with multiple employers is now being offered. So what this means is that from 1 January 2020, eligible employers with multiple employers can apply to opt out of receiving super guarantee from some of their employers. This will help high income earners avoid unintentionally going over the concessional contributions cap. So individuals may be eligible to opt out if they have more than one employer and expect that their employer's mandated concessional super contributions will exceed their concessional cap for the financial year. So if you're an eligible high income earner and you wish to apply for this measure, you need to submit what is called an SG opt-out for high income earners with multiple employers form, and then the ATO will issue you with the SG employer shortfall exemption certificate. Basically, this certificate, it releases one or more of your employers from their SG obligations for up to 4 quarters in one financial year. Individuals will still need to get SG contributions for at least one of their employers for each of those quarters. It's also important to note with this that you can still get an exemption certificate and your employer can choose to disregard that. So it's important that if this is something that impacts you, have those discussions with your employer. So this benefit too, it may not benefit everyone who's eligible. High income earners, you really need to consider your employment arrangements, how you're paid, other entitlements that may change, and the effect of any award or workplace arrangement or agreement, that's applicable. So your accountant or your tax agent may be able to provide you with some further advice based on your personal circumstances. And you'll see there's a link to the form if this applies to you. So generally, there are some age-related conditions that apply when you want to contribute money to your superannuation fund. So depending on your age, at the end of the income year in which you make the contribution, you may need to satisfy what we call a work test or meet the work test exemption criteria in each income year that you are looking to make a contribution into your fund. So to satisfy the work test, you must work at least 40 hours during a consecutive 30-day period each income year in order for your fund to accept the personal super contribution. So usually it was that this was something that you had to do once you'd hit age 65. Now, there's a work test exemption that was introduced from 1 July 2019. To meet the work test exemption criteria, you must have satisfied the work test in the income year preceding the year in which you made the contribution. So if you're making a contribution this year, you had to have met the work test in the 2020 financial year. You have to have had a total super balance of less than $300,000 at the end of the previous income year. So again, using last year's example, your balance had to be under $300,000 at 30 June 2020, and you must not have relied on a work test exemption in a previous financial year. So retirees can only take advantage of this once, and you won't be able to make contributions in subsequent financial years. The opportunity is only available in the year immediately following the year in which you last met the work test. So another change that has happened is that, well, last year the government in the federal budget included some measures to allow older Australians more flexibility to continue to contribute to the super after 65. So specifically the proposals were to allow 65 and 66-year-olds to make or receive super contributions without meeting that work test of the 40 hours in a 30-day period test. They also wanted to allow those turning 66 and 67 to trigger the non-concessional contribution bring forward arrangements. And they also wanted to allow those aged 70 to 74 to receive spouse contributions. So amendments have been made to the SIS regulations so that from 1 July 2020, fund members aged 65 and 66 will be able to make contributions into their super fund account without meeting that work test requirement. Following the removal of the work test requirement for personal contributions by super members over age 65 and 66, there is accompanying legislation that is going through Parliament right now covering the rules for the bring forward arrangements. So this legislation will allow fund members who are 65 and 66 to use the existing bring forward rules for non-concessional contributions, which will allow them to make up to 3 years of non-concessional contributions, which is 3 times 100,000, say $300,000 in a single financial year. This legislation is currently before the House of Representatives, and it is yet to be passed and move into effect. So the next slide is going to show you the work test and the work test exemption conditions. So these slides will be available at the end of the presentation. Also, as I said, as part of the recent amendments to the SIS regulations, the maximum age at which an SMSF member can receive a spouse contribution has been lifted. So from 1 July 2020, spouse contributions can be made until the receiving spouse reaches age 75, which is up from the previous limit of 69. And the receiving spouses aged between 67 and 75 will still need to meet the requirements of the work test. Okay, so ATO website and MyGov. So there's been a lot of updates happening on the ATO website, but we've just picked out a couple of important ones to mention to people that relate to super. So one of them is that there's been an SMSF audit or review. So the ATO has provided a summary of issues of concern when they've reviewed the performance of SMSF auditors, really looking into things such as auditor independence, their knowledge of the SIS Act and the SIS regulations, and also whether they're getting sufficient documentation to support and the audit file, and also whether they're failing to report contravention. So they've identified these as issues. There's also a new accounting standard that will apply, AASB 2020-2, which applies from 1 July 2021. So what's happening here is that there's a new amended accounting standard that's been released by the Australian Accounting Standards Board, and it will come into effect from 1 July 2021. So what's happening under this is that certain for-profit private sector entities will no longer be able to self-assess financial reporting requirements and prepare special purpose financial statements if their trust deeds were created or amended on or after 1 July 2021 and require preparation of financial statements that comply with the Australian accounting standards. So this means that any of these entities will now need to prepare at a minimum Tier 2 general purpose financial statements that comply with all the recognition and measurement requirements in the Australian accounting standards and the minimum simplified disclosures. So what this means for superannuation funds is that any new SMSFs that were set up, that will be set up after 1 July 2021, and they wish to continue preparing special purpose financial statements, are going to need to ensure that their trustee does not have a clause that requires their financial statements to be prepared in accordance with the Australian accounting standards. Similarly, existing SMSFs that intend to change their trust deed after 1 July 2021 should remove any such clause if they want to continue preparing special purpose financial statements. So most SMSF trust deeds refer to financial statements being prepared in accordance with the super laws and do not refer to the Australian accounting standards. So this should not become an issue for the majority of self-managed super funds, but it's really important that, this is something that you consider when you are updating or applying for a new deed. So there's a link on there as well with information to the ATO website. The SMSF December 2019 quarterly statistics were also released by the ATO on the 30th of June, a little bit behind where they might normally be. We might normally see around now the March. The ATO has also released instructions to auditors regarding changes that have happened around auditor contravention report and SMSF independent auditors report due to the COVID-19 relief that will apply for the 20 and 2021 financial years, just on how they need to handle those things. The ATO has also released information on the government's temporary reduction to the minimum pension drawdowns, which I discussed previously, and there's the link there attached if you want to read up more on that. So speaking of the government's COVID release measure, thought that we'd go back and have a little bit of a touch base on MyGov, because this is how people have to apply for their COVID early release. They have to do it through the MyGov app with their ATO online, but there's also a lot of other things that you can use your MyGov and ATO online for. So just thought we'd have a little touch base on it. So MyGov is what we call this whole of government authentication solution, which is accessed through the website address that I've got there, so just my.gov.au. It enables individuals and sole traders to link a whole range of government services with one username and password all in the one place. So for myself, I have my Medicare, the ATO, all set up. I think my private health record as well is there. So you must link your MyGov account to the ATO to be able to use the ATO online services. So a lot of people are moving on this. If they've got really simple tax returns, they do it through the ATO online services as well. So MyGov also includes a MyGov inbox. So once you've registered, you receive all of your messages from the linked government agencies to this one place, and they stay there. It also includes a Tell Us Once service. So that means if you need to update your contact details for multiple linked government agencies, you get to do it in the one go. So you can update Centrelink, Medicare, and ATO all at once. No filling out different forms or doing contacting multiple agencies. So with that, what can SMSF members, or even individuals who don't have an SMSF, what can you do? What can you see? What can you use ATO online via MyGov for? So it's really good. It allows you to see your balance cap details, which might be relevant if you've got a high balance over 1.6 million and you want to know whether you can make non-concessional contributions and some other things. You can see your bring forward arrangements to see if you've triggered them in the last 3 years and what your remaining cap may be. You can also find your lost and ATO held super, and then you get to transfer it into an active super fund account all through the app. You can see what your employer has paid a super guarantee obligation, so it'll be on an income statement, as they call them, in the app. You can see employer contributions that have been reported to your super fund. You can also elect if you have Div 293, you can pay your super liabilities from there, also your excess contributions tax. You can see any of your super accounts that you've closed from 1 July 18. You can apply to access some super early in limited circumstances, such as compassionate leave, or the COVID relief measures. And also you could apply for the First Home Super Saver scheme and get related information. So they're just a few of the key things that you can do on there now. All right, so was bringing up, I mentioned earlier, a reminder about the SMSF annual return Part A and Part B qualifications. So prior to the 2019 SMSF annual return, SMSF trustees were only asked on their the annual return or the tax return whether Part B of the audit report was qualified. Now the tax return also asks whether Part A was qualified. So what is Part A or what is Part B? So Part B of the auditor report gives the auditor's opinion on the fund's compliance with the super laws, while Part A of the report gives the auditor's opinion on whether the fund's financial statements are fairly presented, that is, that there are no material misstatements. So generally when conducting the audit of the financial statements of the super fund, the auditor is required to seek sufficient and appropriate audit evidence that the assets and liabilities of the fund, that they exist, that they are clearly owned by the fund, or are obligations of the fund in the case of liabilities, that they're appropriately valued in the financial statements according to the relevant accounting standards, and the ATO requirements, and that they're appropriately classified in the financial statements according to the relevant accounting standards, and that no material assets or liabilities have been excluded. So trustees must now answer yes if the audit report was qualified at Part A and Part B, regardless of the auditor's reasons for the qualification. So as a bit of an example of what we've found in the 2019 financial year is that some super funds might hold foreign shareholdings, and those shareholdings are appearing on their broker statement, but we're unable to get actual documentation from the foreign share registry that confirms they hold those shares. So the auditor is reporting at Part A that there's a qualification because they can't confirm the existence of those foreign shareholdings as at 30 June. So that's being reported to the ATO. It's appearing in the audit report and on their management letter. It's not anything of concern, but it's just something that they're moving to say, couldn't confirm the existence of this, we're bringing it to your attention. So there's some more information available on the link that you can see there. If you have any questions or you're getting, a Part A or a Part B qualification, reach out to your accountant, administrator, and the auditor, and make sure that you get them rectified. Okay, so now let's have a look at contribution caps. So the contribution cap for concessional contributions remains unchanged at $25,000 for all individuals, regardless of age. Most taxpayers under the age of 75 therefore have the opportunity to claim a tax deduction for personal super contributions made to a complying fund or an RSA. So from 1 July 2019, we have what we call the catch-up concessional contributions. So what this means is that you can use any of your unused concessional contribution caps amounts from the previous years if you're eligible. So the ability to make catch-up concessional contributions applies to people who have a total superannuation balance that was less than $500,000 at 30 June of the previous financial year. Your unused amounts are available for a maximum period of 5 years, and after this, the period will expire. So this 5-year carry forward period started on 1 July 2018. So from 1 July 2019 was the first year that people could actually go and make those catch-up payments. So in the 2020-21 financial year, you can make extra concessional contributions using any unused super contribution caps from the prior 2 years. So as an example, you've got under $500,000 in your super balance as at 30 June 2020. The cap for 19 and 20 was $25,000 each year. You only put, say, $20,000 in each of those years. You have $5,000 left from each of those years, so you have an extra $10,000 available that you could contribute in the 2021 year. So therefore, your cap is for the 2021 year is not the $25,000; it's now $35,000. So it's a running balance thing that's going to happen for 5 years. As I said, it'll expire. It can be a little tricky maybe for you to keep track of it, but if you have a MyGov account, the ATO is keeping that information available in there as well. Okay, so in relation to the concessional contributions caps, work tests will still apply. Oops, I haven't updated that for people aged 67 or less. 67 or over, as the usual notice requirements continue to apply for personal deductible contributions. Any unused caps can be carried forward regardless of your total super balance, but will expire after the 5 years. So additionally, where a member meets the conditions to make catch-up concessional contributions, your increased concessional contributions cap is used to determine the maximum amounts that can be split with their spouse for the purposes of contribution splitting. So before I just said you might have had an extra $10,000 carried forward from the 19 and 20 year. That means if you put that in this year and you make a total of $35,000, if you are able to split that amount with your spouse and roll it into their super account, it'll be 85% of $35,000 that could be split with them. All right, the non-concessional cap. Again, no changes here. It remains at the $100,000 for members. The non-concessional contribution cap will be nil, though, for a financial year if you have a total super balance greater than or equal to the general transfer balance cap, which remains at $1.6 million for the 2021 year. This is based at the end of the 30 June of the previous financial year. So if you have a balance of more than $1.6 million in your super fund, not just your SMSF, at 30 June 2020, you will not be able to make any further non-concessional contributions. In this case, if you were to make any non-concessional contributions in that year, they will be excess non-concessional contributions. So when you're approaching the $1.6 million cap, care really needs to be given and taken with the bring forward rules, as they are restricted by this balanced cap. And now the non-concessional contributions amount that you can bring forward, and whether you have a 2 or 3 year bring forward period, will depend on your total superannuation balance at the end of the 30 June of the previous financial year. Here's a little table that sets out what it is. So from the 2021 year, to access the non-concessional bring forward arrangement, you must be, well, this is to go through legislation, but under 67 years of age for 1 day during the triggering year, and your total super balance must be less than $1.5 million at 30 June 20. The remaining cap amount for years 2 or 3 of a bring forward arrangement is reduced to nil for a financial year if your total super balance is greater than or equal than the balance cap. So that's just them there, set out to show you. So what are the other contribution caps that apply to super for the current financial year that we might need to consider? So super co-contribution, this is designed to assist low to middle income earners save for their retirement. So if you are eligible and you make personal super contributions during a financial year, the government will match your contribution with a super co-contribution up to certain limits based on income thresholds. So the maximum super co-contribution for the 2021 year will remain at $500,000. However, it is the lower income threshold which has increased to $39,837, and the higher income threshold has also increased to $54,830. I've got 7 and 4 written there. I've got a typo somewhere. Okay, so from 1 July 2017, the government introduced the low income super tax offset, or the LISTO, to assist low income earners save for their retirement. So individuals who have an adjusted taxable income of under $37,000 may be eligible to receive a refund into their super fund account for the tax that's been paid on their eligible concessional super contributions up to a cap of $500. Another one is that individuals aged over 65 or over may be able to make their non-concessional contribution to their super of up to $300,000 from the proceeds of selling their home. These contributions will not count towards the non-concessional contribution cap, and the individual making the contribution will not need to meet the existing maximum age, work, or $1.6 million balance tests that usually apply when someone aged over 65 years or over makes a contribution to super. If the home is in joint names, both members of the couple can contribute to their superannuation fund, thereby allowing up to $600,000 to be contributed to super. There's still eligibility requirements that must be met, which is that the contract for the sale of the property had to be dated after 1 July 2018, that the property must be must have been owned by the individual either solely or jointly for the past 10 or more years, that the property must have been the principal place of residence of the individual, and that the contribution must be made within 90 days of the disposal. The individual must choose to treat the contribution as a downsizer contribution and notify their superannuation provider in the approved form of choice at the time the contribution is made. And the individual cannot have used the downsizer contribution measure in relation to an earlier disposal of a main residence. More information is available on our website, and there's just a link there if you'd like to run through it. So what are some of the other super rates and thresholds that are applying? So the ATO has published some key superannuation rates and thresholds for the upcoming financial year. So the super guarantee rate, it remains unchanged at 9.5% of employees' ordinary time wages or salary. It's still scheduled to progressively increase to 12% over time, which is set out in the attached table. So you can see that it's proposed from next financial year to go to 10%. We'll see what happens between now and then. So there are some other superannuation rates and thresholds. So the maximum contribution or super contribution base is now $57,090. So this is basically employers do not have to provide the 9.5% super guarantee if an individual's earnings is over that in a quarter. So the maximum contribution is that they do 9.5% of the 57,090. So an individual may contribute certain proceeds from the sale of assets in the course of carrying on a small business and elect for them to count towards a separate lifetime CGT cap rather than the non-concessional or concessional caps. So this is the CGT cap. And the amount that this is set at for 2020-21 is $1,565,000. So it's increased by $50,000 from 1920. Now, an individual's total superannuation balance will not impact their ability to contribute CGT exempt amounts. However, any CG contributions once made will count towards an individual's total super balance. So then it may actually impact a range of other measures, such as using your future non-concessional cap. So it's really important that if you do make a capital gain and can look at moving it into super, that you talk to your advisor about the timing of any CGT and non-concessional contributions. So if you've reached your preservation age and you're withdrawing super before you turn 60, the low rate cap is the limit on the amount of the taxable components, that is the taxed and untaxed elements, of a super lump sum payment that you will basically receive a nil rate of tax on. It is a lifetime cap, which means that if you have taken advantage of the cap previously, then your cap will be reduced by the previous payment amount. So the low rate cap amount for the 2021 year has increased from $210,000 to $215,000. So in simple terms, if you've reached your preservation age and are under 60, under the low rate cap, you can effectively pull out $215,000 in lump sums from your super tax-free. Once you've reached your lifetime low rate cap, any further benefits will be taxed at a higher rate. The untaxed plan cap is a limit set on the concessional tax treatment of benefits that are paid as a lump sum from untaxed elements, and it's indexed each year, and it's also at 1.565, the same as the CGT lifetime cap. And then Division 293. Div 293 is an additional tax of 15% that are paid by people whose combined income and concessional super contributions exceed what we call the Div 293 tax threshold. So basically, if your income and your concessional super contributions are over $250,000, you're going to have to pay 15% on those contributions. And then the other rate that is of note is the related party limited recourse borrowing arrangement interest rates. So the ATO's safe harbour interest rates for where you've had a related party loan to your SMSF is 5.1% for the real property and 7.1% for listed securities. And another one, there's a couple of slides that I've put in here. It's just your preservation age, which they haven't changed in a long time. They're just there for reference for everybody, and some of the most common conditions of release. So that will tie back into some of the other things we were talking about with lump sums. Okay, so educational resources for SMSF trustees. It's not on a slide, but I just wanted to remind everybody that at Vincents, we recognise the importance of trustee education and being supported with resources to assist you feel informed and to help you feel in control of your self-managed super fund journey. So as a member of the SMSF Association, which is the independent professional body that represents Australia's SMSF sector, we have the following SMSF trustee resources available on our website. So there are detailed SMSF foundation courses and a guide to establishing a self-managed super fund. There's some key compliance resources related to thinking about SMSFs, setting up an SMSF, contributions, rollovers, some investment education, information on paying benefits and administering and reporting with your fund, as well as estate planning. There's also an archive of important news articles and updates on topical SMSF issues, including legislation changes and the annual federal budget announcements and information. There's also information on upcoming live events presented by the SMSF Association that you may wish to attend. So we hope that you find these resources valuable to complement our advice services and keep you up to date. And these can all be accessed at www.vincents.com.au/superannuation-advisory-resources. So please feel free to contact us to discuss any questions you may have in relation to the information provided and how it may impact your specific circumstances. So that concludes today's quarterly superannuation tax update. Thank you for sticking with me. Vincent's Superannuation Advisory is here to work with you to ensure that your SMSF structure is fit for purpose to achieve your desired results. So we can help you with structuring and strategy advice, SMSFs, retirement and estate planning, as well as a range of consultation services that we offer to trustees, accountants and lawyers, whether it be with highly technical matters or just assisting with super and divorce settlements. So if you have any questions, please do not hesitate to contact me on the details that are listed in the next slide, in this slide. And until then, I hope everyone stays healthy and safe. Thanks, guys.